My name is Michael Jacobs. I am the director of the IPPR Commission on Economic Justice. And I've been asked to talk about some of the work we've been doing on corporate taxation. Just to give you some background, the IPPR Commission on Economic Justice is a commission of inquiry into the economy, a 2-year initiative, with commissioners drawn from different walks of economic life, ranging from the Archbishop of Canterbury through to Francis O'Grady, the General Secretary of the TUC, Helena Morrissey, the investor, founder of the 30% Club, a community organiser for Citizens UK in the North East, and a whole variety of other people. And we've been looking at the challenges facing the UK economy, and we're going to make some, I hope, quite radical recommendations for reform. We published an interim report last September called Time for Change, a new vision for the British economy, which I'd urge you to have a look at if you would like to. We've also been publishing a range of discussion and policy papers, and I'm going to talk about the proposals in one of them, a paper we published earlier this year called Fair Dues, Rebalancing Business Taxation in the UK. I want to, however, make a first point which goes much broader than that, and I hope you will forgive me for doing so. Although the focus of the conference is on corporate taxation and paying for businesses paying their fair share of tax, I want to raise the wider issue, which is how much tax we pay as a country, because this has begun to come back to public attention, and it seems to me that it is in many ways the underlying issue which we all need to face, whether or not in your professional capacities for the reason you've come here, certainly in your capacities as citizens. We don't pay enough tax is the core message. We have a public spending share of our GDP, which is about the European average, about 37-38% of GDP. But our taxation as a proportion of GDP is about 33%. We've made that up through borrowing and through asset sales. We've sold a lot of assets over the last 20 years. But we face, as a country, huge demographic pressures which are contributing now to a looming fiscal gap. Over the next 20 to 30 years, as the population ages, which with a much larger proportion of not just pensioners, but elderly pensioners, the ratio of workers who contribute taxes to elderly people and young people, in addition, who don't pay taxes, is declining. Fewer and fewer people are paying taxes for a growing population who use public services, particularly pensions and health and social care. That demographic shift that is going on, that is inexorable, is not something we can do anything about. It means that over the next 20 to 30 years, we are going to have a lower and lower, a larger and larger gap in the taxes that we pay. And it is time, it seems to us as a commission, for the country to face this and to ask, are we paying enough tax as a proportion of our GDP? We've had recently big reports from the Health Foundation and the IFS, Institute for Fiscal Studies, pointing out just how much more money we need from the National Health Service. IPPR has been doing its own commission, chaired by Ara Dazai, the clinician, on the same question. And it is clear that if we're going to have the health service that we want, a social care service that does justice to our elderly population, along with all the other public services that we want, we almost certainly need to pay more tax. So apologies for making a much wider point, but it is in many ways the basis of the discussion that we've been having at the conference today, which is if we need to pay tax, we should be paying it fairly. That takes me then to my second point, which is about corporation tax. The UK has been cutting corporation tax now consistently since 2008. In 2008, the headline rate of corporation tax was 30%. And it was about in the middle, slightly above the average for developed countries. The headline rate of corporation tax is now 19%, so it's been cut from 30 to 19, and the government, at least in principle, plans to cut it further to 17%. The argument for doing this seemed to us to be twofold. One was spurious, clearly spurious, which was, this is the way that we show we're pro-business. And it really seems to me that that argument, which is that the way governments show that they're in favour of business, supporting businesses, is by cutting their corporation tax, needs to be knocked on the head. Businesses pay a multitude of taxes, not just corporation tax. And corporation tax is, of course, the easiest one to pay because it's based on your profits, and therefore it is directly related to your ability to pay it. At the same time as corporation tax have been cut, Employers' national insurance contributions have risen. That is, of course, a tax that is not related to your profit, it's simply related to your employer base. And for many businesses, business rates have also risen. And so we've seen, in a sense, a false argument about that what businesses want from governments is a cut in the rate of corporation tax, which is not the case. And talking to a lot of businesses, they argue that, on the contrary, corporation tax is the one tax that's easy for them to pay because they only have to pay it when they've got the profits to do so. But it's a spurious argument because businesses need many other things from government. The other argument turns out to be spurious as well, but it did have a little bit of economics behind it, which was the so-called Laffer curve, which is the claim that if you cut a tax, and this was applied to business taxation, but in principle could be on other taxes, you will get higher revenues because the lower corporation tax rate induces investment in economic activity, which means that in the end the economy grows through the taxation cut, and in the end, even though your rate is lower, your growth has been higher, your GDP is higher, your corporation profits are higher, corporate profits are higher, and therefore in the end the revenues are higher. The Laffer curve is true only in the simplistic sense that if you have a tax rate of 100%, you've probably got very little economic activity, and similarly at zero. So there is almost certainly some kind of U-shape, inverted U-shape to taxation revenues. But in all the areas of expected profits, it doesn't hold, and there's no evidence for it. And indeed, since we have been cutting corporation tax, we have been losing revenue. So our revenues from corporation tax as a proportion of GDP have been in decline. Now, you obviously need to adjust that for the economic cycle, but broadly speaking, that appears to be the case across an economic cycle. They're now less than the OECD average, as our corporation tax rate has come well below the OECD average, and they are now only 2.6% of GDP. The arguments don't stack up for a reduction in corporation tax. So my second point is, it is almost certainly now time to reverse that reduction and to shift corporation tax back upwards in order that business as a whole pay their fair share. We've made some proposals in this for what you might also do to employers' national insurance contributions, business rates, and so on. But it does seem that at 19%, our rates are much lower now than almost everywhere else. The US has cut its corporation tax recently, but you need to be very careful about the US rate, which has come down to 21%, still above ours, because as well as the federal rate, which is that one, there are also state taxes, corporation taxes in the US. Now, they vary, so that there are some states, Texas, which has very low, others have much higher. But the headline federal corporation tax rate, which is sometimes brought into this debate, is not the only one we need to be concerned about. My third point is about multinational corporations and tax avoidance. One of the things that we've become conscious of over recent years is how easy it is for multinational corporations to avoid corporation tax in different jurisdictions by shifting their profits and their reported activities around between national and indeed, in some cases, state jurisdictions in order to record their profits where taxes are lowest. This is now a recognised practice. There is indeed an international initiative under the OECD, Base Erosion and Profit Shifting Initiative, which is attempting to understand and get to grips with it. But it does create a major problem for tax jurisdictions around the world. And we make a proposal in our report, which comes from Richard Murphy, who is here and therefore could have said it himself, for an alternative minimum, maybe did so, I wasn't here when you spoke, for an alternative minimum corporation tax, which is effectively a kind of backstop tax, where multinational corporations are reporting what look like abnormally low profits for a number of years, that they would be subjected to an alternative form of corporation tax levied on a different basis. And it would then be up to those companies to say to HMRC, you've got it all wrong. We actually have been earning no profits over the last 5 or more years. Here are our books. Here we will show you why that is the case. And then they could be subjected to normal corporation tax regime. But effectively, an alternative minimum corporation tax would place the onus of proof back onto the company once they had qualified for it. We know that this is going on. 800 when the National Audit Office last reported on this, 50% of the largest 800 companies, multinationals operating in the UK, paid less than 10 million in corporation tax in 2012 to 13, with 20% of them paying no corporation tax at all. We don't know how much tax is being lost. It's almost impossible to estimate, but there have been some estimates. TUC last time they looked at it, thought there might be 12 billion in revenue loss. Our proposal then is to have a tax which would basically be worked out as follows. You would look at the global profit rate of a multinational corporation. You would then apportion that as a share of their UK turnover. So you would take the UK turnover, which is a relatively easy thing to work out as a proportion of their global turnover, and then apply their global profit rate to that turnover, assuming that they were making the same profit everywhere, and then apply the corporation tax rate to it. You would do that triggered on after, we think, about 5 years of profits at a low percentage of their average global profits. And this would be a way of capturing multinational corporations' taxes. After all, to summarise, the people who really pay for tax avoidance are the rest of us who have to pay the taxes that are made up. And that includes businesses who, including the fair tax mark businesses, who are paying their taxes properly. In the end, they are the ones who are paying for tax avoidance. And it seems to us time that unfairness will rectify. Thank you.